Last week, we addressed the great debate between permanent insurance and term insurance. Which one should you get? Go check out that episode if you missed it. This week, we're talking about what Dave Ramsey gets completely wrong about cash value life insurance. And there's quite a bit that he tends to get wrong. Now, I'm no Dave Ramsey hater. He says a lot of really good stuff. There is a niche for what he talks about that's very helpful for a lot of people. But try to keep things real here. We're digging into the details. We're going to address the things that he just gets completely wrong about life insurance. Because this is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
This is Jing with Tax Exempt Millionaire Club.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, Dave Ramsey gets quite a bit of stuff wrong. We're going to play the clip, and then we're going to respond to it.
Typical whole life policy accumulates zero cash value in the first 3 years. Have you noticed that? Your cash value buildup for the first 3 years, your savings buildup is zero.
Maybe the worst designed permanent life insurance may have that situation, but most of the permanent policies, you will see the cash value accumulating the first 3 years.
Yeah, realistically, you'll see cash growth in the first 1 or 2 years, even in bad design policies. It's really the worst ones that you wouldn't see any cash for multiple years. And when you get into the really well-designed policies, we have a lot of cash value, even in the first year. So Dave gets that completely wrong. Let's roll the clip on the next thing that Dave gets completely wrong.
The typical whole life policy accumulates at a 1.2% rate. Some of them go as high as 3 or 4%. Some of the universal policies will go as high as 4 to 7%. Some of the indexed universal policies that are indexed to like an S&P after fees will go as high as 7 or 8% rate of return.
Yeah.
Okay.
Yeah.
But the typical basic whole life policy, not a universal policy, is accumulating at under 2%. The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%.
The actual internal rate of return that we're looking to get, and in my own policy, I'm hoping for somewhere between 4 and 6% in my whole life policy. And I'm probably going to be on target in somewhere in that 5% range with whole life. So it's just not true. And if you have the worst design policies, if it's, let's just say whole life, and you heavily fund whole life for a very long time, the really long term, as you get to the late stages of your life, the internal rate of return isn't just completely off of the best designs, because the expenses are front loaded. And in the late stages of life, if you've funded it for a very long time, you will see a good amount of cash value and still probably have internal rate of returns in that 3, 4, 5% range in whole life.
I'm going to get a little nitpicky on this one because there are a lot of really bad products that we just don't encounter too much that get terrible internal rate of returns. And this is realistically what Dave Ramsey is referring to. These studies that he refers to, where they lump in and say this internal rate of return of less than 2% that's happening, it lumps in policies that are only getting guaranteed rates of return because the insurance company basically went out of business or it's not generating any profit, could have low guarantees to begin with or no guarantees to begin with. There's all kinds of things lumped into that. And when he throws out these blanket statements like no cash value for 3 years or policy doesn't return better than 2%, not beating inflation or taxes, he's really talking about these really terrible policies that some people have purchased and uses it as an average, but that's not the case for most policies these days. And realistically, we live in the area of optimized, well-designed, high cash value policies. So we're nowhere even close to this. Like a 2% average, we're going to beat that by double or more in almost every policy that we sell, I think. All right, next up from Dave, play the clip.
It ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes.
All right, so Dave is implying that putting money into life insurance is not wise to begin with. And I think we debunk that almost every single week that we do this podcast. The money that we put into life insurance policies, it does turn into cash value. Even in poorly designed ones, it will eventually turn into cash value. And that money is liquid and accessible. So you can also do other investments. It's not necessarily a choice of one or the other. So to say that putting money into this keeps you from doing this other wise investment, if you have another wise investment, presumably that investment is going to do better than 5%, which is basically the cost to borrow from our life insurance policies. So I don't know what he's talking about when he thinks that this is going to hinder that from happening. It really doesn't if you have a good plan. Now, for a lot of people that aren't exposed to the information that you get from this podcast, that could be true. But again, he's lumping everything together in order to make this pitch to not buy these products. I think he's just completely wrong.
And, I think a lot of us do things like James mentioned. I could pay off loans that I have against my life insurance with funds that I have in my brokerage, but I'm earning better in my brokerage than I am in the cost to borrow for my life insurance policy. And then actually, I've earned some arbitrage on many of those years that I've kept those loans out against my life insurance. So I'm not saying everybody should do that, but we practice these things and do these types of things in our own practice.
All right, next up from Dave. This one's a good one. This one was the main reason why we decided to do this actual podcast. Play the clip.
Oh, here, by the way, after you paid extra on this all these years and you die, they only pay the face value. They don't pay the face value plus your savings that you've been paying extra to build. So it's like a savings account with a crummy rate of return.
They get locked up.
That when you die, they keep your money. If you die, your wife, the beneficiary, I assume, would get $1 million. That's your face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah,
correct.
whoever the beneficiary is going to get the $1 million.
Right.
That's what they're going to get. That's all. And after that, if it builds up a cash value of $5,000 or $10,000 after 10, 15, 20 years, right?
Yeah.
Okay.
Right.
They die with a $60,000 whole life policy with a $15,000 cash value that they've paid extra to build the cash value. With a $60,000 whole life policy, would you agree with me that the insurance company is going to send them a check for $60,000?
Only the 60,000.
Exactly.
Correct.
So you paid for a savings program, and when you die, they keep your money.
Well, in reality, the death benefit paid includes both the base coverage and the accumulated cash value. Often, the death benefit will grow over time as the cash value grows. This means the cash value is actually not lost, but added to the death benefit onto your beneficiary. You should never think about the insurance will keep your accumulated cash value.
Exactly. We've addressed this in other episodes of this podcast as well. But essentially, there are specific types of insurance that if you're interested in making sure you get the cash value and the death benefit that you started out by paying, it's called an increasing death benefit. And it'll just increase dollar for dollar with the cash value. But the reality is your cost inside of a life insurance policy is based on the difference between the cash value that's accumulated and the remaining overall death benefit. So you always get that cash value. The cash value is technically the current value of the future death benefit. Kind of complicated when we say it that way, so we don't often say it that way, but that's the reality. Cash value is always a part of that death benefit. Well said, Jing. All right, Dave, you're up again.
I mean, I have really good friends that used to sell whole life insurance. And once they actually, because I just pound the crap out of them, but I mean, they finally just like, I get it, and I can't sell it anymore because I have a conscience. If you have a good friend that is a payday lender and is ripping off poor people at 800% interest, that's called oppressing the poor. You do not want to read in the Bible what God does to people who oppress the poor.
One thing about Dave Ramsey's baby steps is, in general, they can work for people who are working class to build a solid starting point to have cushion for emergencies. But it can also lead to dangerous situations when you have a high savings rate and a low earnings rate. Because I think one of his steps, save $1,000, he hasn't adjusted for inflation. He's explained that for different reasons, but that's not a very good cushion. And this can lead to a situation where you might run into having to draw from other funds. And if you're drawing from a 401k that you're locking up funds, that can be a dangerous thing. So really, when you have that emergency fund, so that 4 to 6 months that's saved up in wherever he might say to park that inside of a savings account, that's a really great place to have something like whole life and still be getting a good return over the life of that policy. So that's, I think, a good place to have one of these types of policies. But at the same time, even if you're working class and on the lower end of that spectrum, saving heavily inside of a 401k with the strong possibility of having to pay penalties, it can be a dangerous thing. So I think he's completely wrong on this.
Agreed. All right, Dave, what else do you got for us?
The irony is that we really don't necessarily need life insurance for our whole life.
Right.
So if you've got $2 or $3 million in your investments and zero debt, and the kids are grown and gone, and you die, well, I think your wife will be okay.
Okay, so that's a blanket statement to say that life insurance isn't needed for one's whole life? There are so many reasons why you might want life insurance beyond when you become financially secure. Maybe you become extremely financially secure, and now you've got to worry about estate taxes. Life insurance can be great for dealing with estate taxes. How we utilize life insurance for the cash value and having that line of credit accessible for the rest of our life at a really low fixed interest rate is amazing for taking on investment opportunities in the future throughout the rest of your life, especially once you're financially secure. I could go on and on about the reasons for having cash value life insurance beyond once you build up a substantial amount of wealth. But I think if you spent any time on this channel, you already know a lot of these arguments. Dave, you're totally wrong on this one. What else do you got?
As painful as it is, and I'm hurting with you right now, and I'm kind of angry at this character for putting you in this thing. As painful as it is, I would stop.
When you have a situation where you've been funding policy for a number of years, there are scenarios when it's really bad with a really bad carrier where even talking to one of us, we might say it makes sense to cut your losses on this one. If you have a little bit of cash value, you can do something like a 1035 exchange. But in a lot of cases, there's tools that you have at your disposal in both whole life and IUL that you can just stop funding it if you funded it past that 7-year mark. So reduce paid up on the whole life side, and you can have cash value growing. If it's a good carrier and you want to keep that policy going in force, you can have that going for a long time, until you die. You can have what you paid in already paid up. On the IUL side, you reduce to the guideline minimum death benefit, and that cash value should continue to grow as long as you have a good carrier and you're using good indexing strategies. So you'll have minimal costs in that IUL. So there's a lot of ways that you don't have to completely cut your losses and just cash out everything. It can be really advantageous in many scenarios to keep a policy or at least 1035 it.
And realistically, in the case of whole life insurance, those policies get better and more efficient over time. It's pretty rare when you're better off cutting your losses for one of those policies. Not saying it doesn't happen. It certainly can happen, but it's pretty rare, I think.
I would say that I think the scenario where it does happen is if it's a really bad carrier, maybe that's where it might not be advantageous.
Yeah, I mean, ultimately, the death benefit is reliant on the claims paying ability of the carrier. All right, Dave, last one. Give it your best shot.
Thought whole life was going to be like timeshares where it just kind of dies over time, but TikTok has caused a renaissance of whole life agents to start their financial planning influencer careers.
You're kidding.
And so now
they're like whole life guys that are trying to make it cool again.
Well, they're peddling it with new terms.
Make whole life cool again.
You've seen this: index universal life, infinite banking. Dave,
infinite
the wealth
banking
this is
back?
the hack wealthy people don't want you to know.
Infinite banking is back? That was a scam from like 20 years ago.
Well, Gen Z is eating it up on the TikTok, Dave.
Oh, man.
It's caused this resurgence.
Infinite banking is code for whole life that sucks bad. That's what it is. So the infinite banking is you put so much in the whole life that it starts to pay its own
premium. And you
premium.
borrow money from yourself, Dave. It's genius.
You borrow money from yourself, and guess what? There's no taxes on borrowed money. Well, no kidding, doofus. There's never been taxes on borrowed money.
Life
if you just
hack.
run over there and get you a credit card debt,
oh my gosh.
There's no taxes on the debt, you dumb butt. Of course there's not. Why is
my goodness.
I can't believe infinite banking is being made cool on TikTok.
Okay, now Dave is in our wheelhouse. He's talking to infinite banking and tax-free wealth strategies, and that somehow whole life is still bad in that scenario. Oh, he has not seen what we do here, where we design high cash value policies that are amazing for tax-free wealth strategies, having lines of credit to use for infinite banking in the future, and getting good internal rate of returns with really high liquidity right out of the gate. So it's not a bad idea that seems cool and sophisticated. It is pretty cool and sophisticated when you get a properly designed policy. So we live in the exceptions. Most everything we've talked about in this episode is something Dave got completely wrong about even bad designed policies. But in this scenario, he's attacking even what should be good design. Now, there are some poorly designed infinite banking policies, but even those ones are miles ahead of a bad, normal, regular designed cash value policy that I would never purchase. So, Dave, if you're going to step into that space, you got to bring a lot more to the table because we got the receipts. And with that, do you guys have any call to actions for our viewers this week? It's time for this week's call to action.
Well, I really want to bring this up because Dave Ramsey, I know everybody knows his show, but because he's a famous figure doesn't mean every single statement or argument he's saying is 100% correct. I'll call for action for our audience to come listen to our show and then do the judgment, educate yourself, and see if permanent life insurance is a good choice at your particular situation.
If you are following content creators out there that are in the financial space and they have targeted whole life and IUL and infinite banking, I want to hear from you. I want to hear, comment below, maybe link to a video that you think we didn't address. I've watched plenty of them and we'll probably do future episodes on some of these other creators, but would love to hear from you and your thoughts, what you want to see addressed in this type of an episode.
And along those lines, my call to action is, if you're listening to this as a podcast, find us on YouTube. There's a comment section there. If you heard anything that you disagree with or you think we didn't address, put it in the comment section. We would love to hear from you. Our main goal here is to help answer all of the questions that any of you might have when you're researching this stuff and trying to decide if this is right for you. So this is the place to do it. Look forward to hearing from you guys in the near future. And next week, we're going to be bringing you modified endowment contracts, everything you need to know about them. So be sure to check that out. I'm your host, James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And my name's Jing, your host of Tech Exam Millionaire Club. You can scan the QR code to join the school community. I'm also licensed in multiple states as an independent life insurance agent. I'll look forward to hearing from you and discuss my IBC policy and my experience.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. We'll work with life insurance clients across the country.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.